Welcome to Iron Financial. This is the place where we help you forge a stronger portfolio by putting the market's biggest companies through a serious stress test. Today, we've got a true giant on the anvil, CVS Health. They've just released their latest earnings, and folks, the numbers are telling a fascinating story. It's a story of absolutely massive scale, but also one of deep, deep structural pressure. Our job today is to cut right through the corporate buzzwords and the market chatter to figure out what is really happening inside this healthcare behemoth. So let's get right to it. Okay, let's start with the headline, the number that's designed to blow you away. $402.1 billion in full-year revenue. Look, you have to understand, this isn't just a number on a spreadsheet. It's a declaration of power. It's a financial fortress, a wall of cash and market share that looks from the outside completely unbreakable. When you're pulling in that kind of money, you're not just another company on the S&P 500. You are a core piece of the entire U.S. healthcare system. This is the number that is supposed to scream stability, dominance, and unshakable strength. It's the bull case in a nutshell. An unbreakable fortress, huh? Well, the moment that earnings report hit the wire, the stock dropped 2.5%. So what does that tell you? The market saw that $400 billion wall, and instead of being impressed, it immediately started looking for the cracks. That is not the kind of reaction a healthy, confident company gets. Not at all. That's the reaction you see when savvy investors smell something off, when they think there's trouble hiding behind that big, shiny number. So the real question for us, and for everyone trying to make sense of this, is simple. What did the market see that isn't immediately obvious? Is this all just hype, or is something fundamentally wrong here? And that right there sets up the entire mission for our analysis today. It's the central conflict. On one side, you've got this incredible image of a revenue-generating fortress, an absolute titan of industry. But on the other, you have a market that's voting with its feet, suggesting some serious vulnerabilities. So which is it? Is CVS Health really a steel fortress built on the very bedrock of American healthcare? Or is it more like a house of cards, where one wrong move, one gust of wind, could bring the whole thing crashing down? That's what our stress test is all about. We're here to find out. So here's how we're going to break it down today. Our plan of attack is simple. First, we'll examine that fortress of revenue. Then we're going to go looking for the cracks in the foundation. After that, we inspect what should be their strongest asset, the bedrock pharmacy business. From there, we move to the part of the business that's under attack, the PBMs under regulatory siege. Then we'll look at management's response with the 2026 battle plan. And finally, we'll put it all together and give you the iron financial verdict. Let's dig in. All right, Section 1, the fortress of revenue. Like we said, $402.1 billion. Let's put that in perspective. This is the top line, the sheer mind-boggling scale of this operation. And it's not just big, it's growing. Revenue is up almost 8% year over year. In today's choppy economic waters, getting that kind of growth when you're already this massive is genuinely impressive. It shows they still have the power to command the market and pull in cash from every single corner of the healthcare system. But as we all know, the top line, well, that's only where the story begins. Okay, now this table is where things get really interesting, because you see two completely different stories. Look at those top two lines. Total revenues up a solid 7.8%. And look at that adjusted operating income, up a massive 20.6%. This is the slide management wants you to frame and put on your wall. They're pointing to this and shouting, see? The core operational strength is there. The engine is humming. But you can't just slice the table in half and ignore the bottom. That's where the skeletons are. GAAP operating income down over 45%. And GAAP earnings per share? It didn't just fall, it cratered, down 62%. You can't sit there and tell me the engine is humming when the official, audited, by-the-book numbers look like a train wreck. The adjusted number is the beautiful story management wants to sell. The GAAP number, that's the cold, hard reality. So my question is, what exactly are they adjusting away? And that is the multi-billion-dollar question. The answer is they're adjusting for almost $7 billion in charges that they're calling one-time items. Now, this isn't about day-to-day operational weakness. This is a massive financial house cleaning. The single biggest piece of this is a staggering $5.7 billion goodwill impairment. In plain English, that's the company finally admitting on paper that they wildly overpaid for a past acquisition in their healthcare delivery business. On top of that, they took another $1.2 billion hit for old litigation charges. So the bull case here is that these are non-recurring, one-and-done events, a painful but necessary write-down that clears the books for a more profitable future. The bear case, of course, is that a track record of overpaying for assets and constantly getting hit with billion-dollar lawsuits isn't a sign of a well-run, disciplined machine. So, let's start probing for those cracks. We're going straight to the healthcare benefits segment. This is Aetna, the insurance juggernaut they bought a few years ago. This is supposed to be one of the main pillars holding up the entire CVS fortress. If this pillar is rotten, the whole structure is at risk. So let's see just how sound it is. At first glance, you see what looks like continued strength. Revenues are up over $3 billion just in the fourth quarter. I mean, that's more than many entire companies generate in a full year. So they are clearly still growing the insurance side of the house. Growing, sure, but at what cost? How in the world do you grow your revenues by over 10% and somehow manage to lose even more money doing it? Look at that middle line. They posted an adjusted operating loss of $676 million. Let me say that again because it's just staggering. A massive health insurance company lost over $500 million on its core business in a single quarter. This isn't just a little crack in the foundation. This is a gaping sinkhole opening up right underneath one of the main support pillars. How is that even possible? This number right here, this is the smoking gun. 94.8%. That's their medical benefit ratio, or MBR. And this one number perfectly illustrates the core of the problem. What this means in the simplest terms is that for every single dollar Aetna brought in from customer premiums, it had to immediately turn around and spend nearly 95 cents just to pay out medical claims. Think about that. That leaves them with just 5 cents on the dollar to cover everything else. All their employees' salaries, marketing, technology, rent on their buildings, and oh yeah, somewhere in that nickel, they're supposed to find a profit. You simply cannot run a sustainable business on a 5% gross margin, especially not a complex insurance giant. They are living on a razor's edge, and right now, they're bleeding. Exactly. And for everyone watching, let's just make sure we're crystal clear on what this MBR metric really is. It is the single most critical, vital sign for an insurance company. A high MBR, like what we're seeing here, means that medical costs are out of control and are eating up nearly all of the premium revenue. It's squeezing profitability down to almost nothing. Now, management is pointing fingers, blaming elevated medical cost trends and unfavorable Medicare Advantage rates from the government. But honestly, regardless of the excuse, a 94.8% MBR is a massive, flashing, bright red warning light. It tells us unequivocally that the Aetna pillar is under severe financial distress. Okay, so with the insurance foundation showing some very serious cracks, let's pivot. We're now going to inspect what should be the strongest, most stable part of the entire CVS fortress. This is the bedrock. This is the massive retail pharmacy and consumer wellness business. We're talking about the 9,000 stores that are a fixture in just about every town in America. This part has to be solid. If this is weak, the entire investment thesis just falls apart. And here, finally, the numbers look like solid granite. Just look at this data. Total revenues up over 12%. Adjusted operating income up almost 9%. And maybe most importantly, the core activity, the actual reason people go to CVS, filling prescriptions, is up a very healthy 6.3%. This is the engine room of the company, and folks, it is performing beautifully. They are getting more people through the doors, they are filling more scripts, and that activity drives the entire enterprise. This segment is doing all the heavy lifting right now. Okay, I have to give credit where credit is due. This chart makes it pretty undeniable. They went from filling just under 446 million prescriptions to over 473 million. That is a huge leap in volume in just 1 year. This isn't some accounting gimmick. That's real, tangible customer activity. It shows that their physical footprint and their brand name are still incredibly powerful draws. But the question is, where did all that new growth come from? Was it organic, or did they just go out and buy it? Well, a huge driver was a very, very smart and opportunistic move. They acquired Rite Aid's prescription files. When Rite Aid went bankrupt, CVS was there to pick up the pieces. And for less than $500 million, they onboarded 9 million new patients. This was a masterclass in strategic expansion. They didn't just buy empty stores, they bought customer relationships and, more importantly, recurring revenue streams, which is great business, no doubt. But it really begs the question of sustainability, doesn't it? You can't count on a major competitor going bankrupt every single year. So while this was a fantastic move that clearly juiced the numbers for this quarter, any serious investor has to ask if this is just a one-time sugar high or if they can actually keep generating this kind of real organic growth moving forward. All right, now we have to turn to the most complex, the most controversial, and potentially the most vulnerable part of the entire CVS fortress, the health services segment. This is the home of their absolutely massive pharmacy benefit manager, or PBM, which is known as Caremark. So if the Aetna business has cracks in the foundation, and the retail pharmacy is the solid bedrock, then the PBM is the part of the castle wall that is under a direct, sustained, and brutal siege from Washington. And before we dive into the battle, we need to pause and define what this thing even is, because for most people, it's a total black box. A PBM is at its core a middleman. They wedge themselves between the big drug companies, the insurance companies, and the local pharmacies. Their stated purpose is to use their immense scale to negotiate lower drug prices for everyone. But for years, they've been slammed for a total lack of transparency, especially around the secret rebates they get from manufacturers and how much of that savings actually gets passed on to patients. It's that opaque business model that has finally drawn the full attention of regulators. And make no mistake, the siege is real, and it is intense. We are talking about major pieces of legislation, like the PBM Reform Act of 2026, which is specifically designed to force transparency and kill some of their most profitable hidden practices. There are new rules coming from the Department of Labor. And just this past January, a House Judiciary Committee report specifically targeted the CVS/Aetna/Caremark vertical integration model, suggesting the very structure of the company could be an antitrust liability. This isn't just background noise. This is a full frontal assault on the entire PBM business model as we know it. So that leads to the critical question: what is management doing about it? What's their defense? Well, they're not just sitting back and waiting for the cannonballs to hit. Their counter strategy is to try and get out ahead of the regulators. They are proactively moving their clients over to new, more transparent pricing models. Models with names like True Cost and Cost Vantage are designed to give everyone more clarity on where the money is flowing. Management's argument is that they're embracing the change. They're saying this new legislation could actually help them by accelerating the adoption of their new models, making them a leader in the next generation of PBMs. It's a bold strategy, really. Adapt before you're forced to. Okay, so we've inspected the whole fortress. We found some serious cracks in the insurance business. We found a solid bedrock in the pharmacy division. And we've seen the massive regulatory siege happening at the PBM wall. So now, let's look at the general's strategy. What is management's actual battle plan for 2026 to try and shore up the defenses and fight back? So here's the plan laid bare. First, and this is job number one, they have to achieve margin recovery in Medicare Advantage. They have to stop the bleeding in the Aetna business, period. Second, they're promising to use tech and AI to drive efficiency and cut costs. Third, they're going all in on rolling out those transparent PBM models. And through all this, they are sticking by their guidance, telling Wall Street they will deliver adjusted earnings somewhere between $7 and $7.20 per share. But you have to look at that last bullet point, a 55-45 earnings split, heavily weighted to the second half of the year. You know what that is, right? That's Wall Street code for the first half of the year is going to be ugly, but please trust us. We promise we'll pull a rabbit out of a hat later. That's not a plan, that's a prayer. It puts an insane amount of pressure on them to execute absolutely flawlessly in the back half of the year. Any hiccup, any slip up, and they don't just miss their number, they completely blow up their entire investment case for the year. And that brings us to our final section, the iron financial verdict. We've stress-tested the revenue, we've inspected the foundation, we've checked the bedrock, and we've analyzed the siege on the walls. We've seen management's battle plan. Now it is time to bring it all together and render a verdict for investors who are trying to forge a stronger portfolio. The ultimate question, is CVS an opportunity or is it a trap? Let's start with the opportunity. The bull case is built on that undeniable, massive scale. $400 billion in revenue gives you incredible power and staying power. The pharmacy business is the strong, growing bedrock of this company, and that savvy Rite Aid deal proves they can execute smart, value-adding deals. Plus, their proactive shift in the PBM business could actually position them as a leader in the new, more transparent world order. The bull argument is that this company is simply too big, too essential, and too profitable at its core to really fail. But the trap, the bear case, is just as powerful. The margin pressure in their Medicare business is real, it's persistent, and it shows no clear signs of getting better anytime soon. The regulatory risk to the PBM segment is nothing short of existential. It threatens the core profitability of that entire division. That $5.7 billion goodwill charge raises some very serious questions about their M&A strategy and capital allocation. And the constant large litigation charges suggest a pattern of costly business practices. The bear case says this fortress is rotting from the inside and the siege from the outside is only getting stronger. And of course, this is what the commander-in-chief has to say about it. CEO David Joyner's official statement is one of complete confidence. Unlock the earnings power of our diversified enterprise. This is management putting on a brave face, telling the market that they believe in the integrated structure they've built. They believe the pieces, the pharmacy, the insurance, the PBM, all work together synergistically. They believe in their battle plan, and they believe they can navigate this storm and come out even stronger on the other side. Which leaves us right here with the final, critical question for you. We've laid out all the evidence. You have a foundation in the Aetna business that is clearly undergoing major repairs. You have walls in the PBM business that are under a coordinated siege from regulators. But you also have a bedrock in the pharmacy business that remains solid as a rock. So for the investor looking to forge a stronger portfolio, is this a crumbling ruin that you should avoid at all costs? Or is this a fortress under renovation, offering a rare chance to build a position at a discount before the reinforcements arrive? That is the multi-billion-dollar question you have to answer for yourself. Thanks for joining us on Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.